What if I told you the next financial crash won't decide who loses money? It will decide who changes social class. Because when the market breaks, it doesn't destroy wealth, it redistributes it. Some people come out financially finished, others come out financially free. And today we're going to answer one question. When the market breaks, who survives the financial crash? Not who panics. Not who predicts it on social media. Not who screams the loudest on TV, but who quietly walks through the wreckage, wealthier than before. And here's the uncomfortable part. By the end of this video, you'll know exactly which side of that divide you're currently on. But to understand that, we need to look at something most people are completely ignoring right now. The illusion phase. Every crash in history begins the same way. Not with panic, and with confidence. The Great Depression didn't begin with fear. It began with celebration. The dot-com collapse didn't begin with recession headlines. It began with technological euphoria. 2008 didn't begin with bank failures. It began with record home ownership and financial innovation. And today, stock markets hover near highs. Unemployment looks stable. Innovation headlines dominate. It feels strong. But underneath that surface strength, something feels uneven. Consumers are strained. Credit card balances are rising. Corporate bankruptcies are quietly ticking higher. Refinancing debt has become more expensive. It feels like two different economies, the financial economy and the real one. And when those two diverge for too long, history tells us something eventually snaps. But here's what most people misunderstand. The break never comes immediately. And that delay is what traps people. But before we talk about what happens when the illusion cracks, we need to understand why the illusion exists in the first place. The warning signals. If the financial system could speak before it broke, it would whisper first. Before 1929, liquidity tightened. Before 2000, valuations detached from earnings. Before 2008, credit conditions quietly deteriorated. And today, global debt is higher than ever. Governments run historic deficits. Corporate leverage sits near extremes. Consumers rely more on credit than savings. The yield curve inverted deeply. Credit spreads widen in pockets. Delinquencies rise quietly. These aren't headline events. They're stress fractures. And stress fractures don't make noise. Until they do. But here's the dangerous part. Markets can rise for months, even years, after these signals appear. In 1928, stocks rallied nearly 2 years after warnings. In 2006, markets climbed even as risk built underneath. That delay creates false confidence, and false confidence creates exposure, and exposure creates vulnerability. But the real separation doesn't happen during the warning phase. It happens when phase 2 begins. And that's where most people lose control. Before we go there, if you're the type of person who wants to understand markets before the headlines explain them, make sure you're subscribed. Because when phase 2 hits, you won't want to be learning in real time. Now let's talk about what actually breaks. What actually breaks first? Most people expect the next crash to look exactly like the last one. They're waiting for another 2008. Housing collapse, bank failures, deflationary spiral. Cash becomes king. But cycles rarely repeat perfectly. Sometimes crashes are violent and fast. Sometimes they're structural and slow. Sometimes the break is in asset prices. Sometimes it's in purchasing power. What breaks first depends on where excess accumulated. Today, excess sits in 3 places: debt, valuations, and duration risk. Debt accumulated during ultra-low rates. Valuations stretched during liquidity expansion. Duration risk priced as if rates would stay low forever. When refinancing becomes expensive, margins compress. When margins compress, layoffs begin. When layoffs begin, consumption slows. The math doesn't care about optimism. And eventually, math wins. But here's the part nobody talks about. The crash itself isn't the most dangerous moment. The most dangerous moment is the transition between illusion and recognition. Because that's when denial is strongest, and denial is expensive. So what happens when recognition begins? The 3 phases of every crash. Every crash follows a psychological pattern. Phase 1, illusion. Markets rise. Data is mixed. Optimism dominates. Phase 2, recognition. Something breaks quietly. A fund collapses. A bank reports losses. Unemployment ticks higher. Phase 3, cascade. Liquidity disappears. Assets drop 20%, 30%, 40%. Fear becomes contagious. And here's where the separation happens. Crashes don't destroy wealth. They transfer it. From the leveraged to the liquid. From the emotional to the disciplined. From the reactive to the prepared. But preparation doesn't happen during phase 3. It happens now. Before the headlines change tone. Before your friends start asking if they should sell everything. And before panic becomes popular. Now here's the uncomfortable question. If markets dropped 30% tomorrow, would you be forced to sell or ready to buy? Think about that, because your answer determines your category. But let's go deeper. Who actually survives? Who doesn't survive? History is clear. The over-leveraged don't survive. Leverage amplifies gains and multiplies losses. In 1929, margin wiped out speculators. In 2008, homeowners with no equity were erased. In every cycle, borrowed stability collapses first. The unprepared don't survive. Those who assume stability is permanent. Those who ignore signals because markets are still rising. And the emotionally reactive don't survive. Because when volatility spikes, instinct screams to flee. Markets reward discipline, not instinct. But survival isn't just about avoiding mistakes. It's about positioning correctly. And that's where most people misunderstand the opportunity. Before we talk about who survives, if you value breakdowns like this, subscribe now. Because understanding cycles before they break is how you stop reacting and start positioning. Now let's talk about the survivors. Who survives when the market breaks? The first survivors are the liquid. Liquidity equals optionality, not because cash always outperforms, but because liquidity allows you to act. When panic forces indiscriminate selling, resilient assets trade below intrinsic value. Those who don't need to sell can buy. The second survivors are owners of resilient assets, businesses with real cash flow. Low leverage, pricing power, scarcity. In deflationary crashes, leverage collapses. In inflationary resets, cash erodes. But productive, scarce assets endure. The third survivors are cycle-aware. They understand that expansion breeds excess. Excess breeds correction. Correction resets the system. Reset begins the next expansion. They don't try to predict the exact day. They prepare for inevitability. Because crashes aren't anomalies. They're structural releases of pressure. And pressure is building. Quietly, bankruptcies rise. Refinancing stress increases. Consumer delinquencies tick higher. These are not dramatic headlines. They are fracture lines. And fracture lines always matter. But here's the most important part. The longer the illusion holds, the more violent the release. In 1928, confidence peaked before collapse. In 2006, Housing peaked before crisis. In every cycle, optimism extended beyond reason. The calm is often the final stage, so when the market breaks, it won't ask for permission. It won't give you time to develop discipline. It will reveal whether you built it. And that's why this question matters. When the market breaks, who survives? Not the loudest, not the most confident, not the most fearful, the prepared, the patient, the disciplined, the resilient. And if you want to stay ahead of that transition from illusion to recognition, subscribe now. Because when phase 2 turns into phase 3, you won't want to be guessing. You'll want clarity. History doesn't reward denial. It rewards preparation. The system doesn't collapse overnight. It cracks slowly, then suddenly. And when it does, the survivors won't look lucky. They'll look ready. So I'll leave you with one final question. If phase 2 begins tomorrow, are you positioned to survive the crash? Or positioned to fund someone else's opportunity? Let me know your thoughts in the comments. And if you're serious about understanding the signals before they become headlines, subscribe to the channel and turn on notifications. Because when the market breaks, it won't warn you twice.